This video is brought to you by togetherbudget.com. So, let's start with the basics. What are mutual funds?
I love this part. Mutual funds are basically a way for individuals to pool their money together to invest in a variety of assets.
That's right. And it's like a big party where everyone brings a little bit of money and you get a diversified portfolio out of it. Ka-ching!
Exactly. But what I love about mutual funds is that they're managed by professionals, so you don't have to be an expert in the market.
Yeah, and let's be real, most people are too busy with their lives to keep up with the market. It's like trying to follow a stock ticker on Twitter, ding ding ding.
Oh my goodness, exactly. So, mutual funds take care of all that for you and give you a slice of the pie.
Now, let's talk about the benefits. What do you think is the biggest advantage of mutual funds?
I'd say it's the diversification aspect. By pooling money together, you get a more stable portfolio and reduce your risk.
That's right. It's like having a fire insurance policy for your investments, phew.
And with mutual funds, you can invest in various asset classes, like stocks, bonds, and even real estate.
Whoa, that's a whole lot of options. But the best part is that it's all managed by pros, so you don't have to worry about making those tough decisions. Okay, so now we've covered the basics and benefits. What about fees? How do mutual funds charge their investors?
Fees, the dirty little secret of the investment world. Whoosh.
That is wild. But seriously, fees can eat into your returns, so it's essential to understand how they work.
Exactly. There are two types of fees, management fees and administrative fees. Management fees go towards the fund manager's salary.
And then there are other fees like sales loads, redemption fees, and 12b-1 fees, ding ding ding. So, let's dive into the benefits of diversification with mutual funds. When you invest in a single stock or bond, it's like putting all your eggs in one basket.
That's exactly right. And we've all heard that phrase before. Chuckles.
Right? So, when you diversify with mutual funds, you're essentially spreading those eggs across multiple baskets.
Haha, nice visual aid. But seriously, how does this help us as investors?
Well, let's say you invest $10,000 in a single stock. If that stock plummets in value, you could lose a significant portion of your investment.
Oh my goodness, exactly. And it's not just about the initial loss, it's also about the opportunity cost of not having that money invested elsewhere.
Phew. Just thinking about it is making me nervous. But with mutual funds, you can invest in a diversified portfolio and reduce your risk exposure.
That's right. And some people even call it risk management, ka-ching.
Now, I know some people might be thinking, but won't diversification just mean spreading my investment too thin?
True. But that's not necessarily the case. With mutual funds, you can pool your resources with other investors and gain access to a professionally managed portfolio.
Ding ding ding. It's like having a team of experts working for you.
Exactly. And that team is constantly monitoring the market, adjusting the portfolio as needed.
Alright, let's dive into the types of mutual funds. First up, we have equity mutual funds.
Equity, got it. What does that even mean?
Well, it means they invest in stocks and shares of companies. The goal is to give you a return on investment that's higher than the market average.
Oh my goodness, exactly. I always thought equity just meant fancy property or something laughs.
Chuckles, yeah, we get that a lot. But seriously, equity mutual funds are great for long-term investors who can ride out market fluctuations.
Okay, got it. Next up?
Debt mutual funds, baby. Ding ding ding. They invest in fixed income securities like bonds and government securities.
Bonds? Government securities? Sounds like lawyer speak to me.
Ka-ching. No, trust me. It's actually pretty simple. Debt mutual funds are for conservative investors who want predictable returns and lower risk.
Predictable returns? That sounds too good to be true.
I know what you're thinking. But seriously, these funds are great for those who want a low-risk investment with regular income.
Okay, so now we've got equity and debt. What about hybrid?
The wild child of mutual funds. Whoosh! Hybrid mutual funds combine both equity and debt investments.
Whoa, that's a mix and match party right there.
Phew! Yeah, it can get complicated. But the idea is to balance risk and reward by investing in a mix of equity and debt.
I see. So, it's like having your cake and eating it too.
Laughs, yeah, something like that. Hybrid mutual funds are great for those who want to diversify their portfolio without taking on too much risk.
Last but not least, we've got index funds.
Ding ding ding. The ultimate team player.
What do you mean?
Index funds track a particular market index, like the S&P 500. They're designed to give you the same returns as the overall market.
Oh wow, that sounds easy peasy.
Chuckles, yeah, it's actually pretty simple. Index funds are great for beginners or those who want a low-maintenance investment option. So, you're looking to invest in a mutual fund and want to know how to choose the right one. Well, let me tell you, it's not like picking a pizza topping. Although, if I had to choose, anchovies would be the clear winner.
Haha, that is wild. But seriously, what are some key factors we should consider when selecting a mutual fund?
Ka-ching. Fees. The silent killer of many an investor's portfolio. But don't worry, we'll get to that in a minute.
Oh my goodness, exactly. Fees can be a huge drag on returns. What are some other things we should look at when evaluating a mutual fund?
Ding ding ding. Performance. The ultimate icebreaker at any investment party. But don't get too caught up in past results, they can be misleading.
True. What are some ways we can gauge a mutual fund's historical performance without getting fooled by the numbers?
So, let's talk about fees. Mutual funds can have a wide range of fees associated with them, from management fees to administrative costs.
Yeah, I've heard horror stories about some mutual fund managers taking huge chunks out of investors' returns. It's like they're sucking the last drop of milk out of the bottle. Ka-ching.
Exactly. And it's not just the management fees that can be a problem. Some mutual funds also have high expense ratios, which can eat into your returns even further.
Oh my goodness, exactly. I had no idea about those hidden fees. Can you break down what an expense ratio is for our listeners?
Now, let's talk about liquidity. Mutual fund investors often assume they can buy or sell shares whenever they want, but that's not always the case.
What do you mean? I thought mutual funds were all about having a diversified portfolio and being able to liquidate easily.
Well, some mutual funds may have less liquidity than others. For example, if a fund invests in smaller companies or illiquid assets, it can be harder to sell those shares quickly.
Whoa, that's like trying to sell a unicorn on the stock market. Ding ding ding.
Finally, let's talk about credit risk. Mutual funds can invest in a range of assets, including bonds and other debt securities.
Okay, I think I know where this is going. You're going to tell me that some mutual fund managers take on too much credit risk, right?
Guilty as charged. Yes, some mutual funds may take on more credit risk than others, which can be a problem if the borrower defaults.
Phew. I'm glad we're talking about this. It's so important for investors to understand these risks.
Alright, let's dive into building a winning portfolio with mutual funds. The key is diversification, my friend.
I couldn't agree more. People often think of mutual funds as a one-size-fits-all solution, but it's so much more than that. It's about spreading your risk and increasing potential returns.
Phew. You got that right. I mean, imagine if you put all your eggs in one basket. Ka-ching!
Haha, that is wild. So, let's break it down. What are some key types of mutual funds we should be looking at?
Okay, let's talk about the importance of long-term investing. People often get caught up in trying to time the market or make quick profits.
Oh my goodness, exactly. I mean, who doesn't love a good get-rich-quick scheme? But it's just not sustainable.
Ding ding ding. You're right on the money, my friend. Long-term investing is key to building wealth.
Now, let's talk about the role of a fund manager. What qualities should we be looking for in someone who's managing our hard-earned cash?
Well, you want someone with experience, a solid track record, and a clear investment strategy.
But it's not just about the numbers. What else should we be considering when evaluating a fund manager?
This tutorial is brought to you by Malik Abwalzait.